Hello and welcome back to this channel. Ultimate Intermediate Forex Day Trading Strategy Course Lesson 9. This video will demonstrate intermediate Forex day trading strategy for traders to prepare their trading setup before they place a trade. There are 4 important trading strategies introduced with some practical examples to show you how you can profit from the stock market. I also implement MACD indicator, Bollinger Band, Bollinger Bandwidth, moving averages, triangle, trend line, and support and resistance to enhance and upgrade your trading knowledge to the next level. What is Forex day trading strategy? The success of Forex day traders heavily rely on strategies that are tried and tested, need discipline on executing these strategies, and finally need a strong and strict money management. Forex day traders rely on technical analysis in order to identify probable price movements and inform trading behavior. The first strategy I'm introducing here is moving average crossover. In this video, I'm going to show you everything you need to know about Forex day trading strategy, including the instruction, implementation, chart pattern, and trading risk management. Indicators such as moving average, MACD indicator, Stochastic Indicator, Bollinger Band and Bollinger Bandwidth indicator, trend line, and horizontal support and resistance is used to help traders to find entry and exit point. Traders are fully aware that indicators by itself cannot make decisions for them, but it can help traders to make their decision-making process easier. Moving average crossover buy and sell signal in an uptrend. This is the price trend, British pound versus US dollar H1 time frame. I installed EMA 20 as a fast moving average, EMA 60 as a slow moving average, and also EMA 100 as trend indicator. Now in Forex day trading strategy, when the fast moving average, which is this one, crosses the slow moving average, which is this one, while going upward, and also the price stay constantly above this EMA 100, then it generates a buy signal. So you can enter the market here and put your stop loss below the EMA 100, maybe 1 or 2 ATR. Now when the fast moving average crosses the slow moving average while going downward, and the price stay below this cross section, and also this price stay below this EMA 100, then it generates a sell signal. So you can exit the market here and put your stop loss 1 or 2 ATR above this cross section. If the price stay constantly above the EMA 100 or below the EMA 100, then you know that a strong price trend is in force, and the trade should be left to run. Let's say the price is coming up and have a little pullback. You should not bother it because it's already above this fast moving average and above this slow moving average and above this. So you should not bother it and let it run. So you see after that the price move upward and again upward, so on. So this indicates that you have a strong a strong uptrend in force. Remember, moving average is weak in range bound and it gives you lots of false signal. So you have to be careful. But after this green cross here, you see the price, how the prices stay above these moving average. And that signifies that we have a strong uptrend. Moving average crossover buy and sell signal in a downtrend. This is the price trend. Swiss franc versus Japanese yen pair, H1 time frame. I installed EMA 20 as fast moving average, EMA 60 as a slow moving average, and also exponential moving average with 100 days period as trend indicator. Now, in this Forex day trading strategy, if the fast moving average crosses the slow moving average while going downward and the price be constantly below the EMA 100, then it generates a sell signal. So this is the cross of the sell signal. You can exit the market at this point, and you have to make sure that the price be below this cross section. Now, if the shorter or the faster moving average, this is the fast moving average, crosses the slow moving average while going upward, and the price stay above this EMA 100, which is above this EMA 100 from this place onward, then it generates a buy signal. So you can enter the market here. If you enter the market here, make sure the price be above this cross section, and you put your stop loss 1 or 2 ATR below this cross section, below here. And if you exit the market here, make sure the price be below this cross section, and you put your stop loss 1 or 2 ATR above this cross section, above here. So that's how you use moving average crossover to enter and exit the market. Here you enter and here you exit the market. The second strategy used in Forex day trading is support and resistance using a stochastic indicator. Horizontal and dynamic support and resistance can be seen in the form of moving averages, wedges, triangles, channels, Fibonacci levels, and so on, and acting as a barrier levels which the price has difficulty to break. It is the most important concept in technical analysis. Forex day traders take profitable advantage of finding many price reversals around these levels. The harder the price to cross these levels, the stronger the reversal would be. Support and resistance using a stochastic indicator. This is the price trend, New Zealand versus USD pair, H1 time frame. I installed the trend line that is acting as resistance area. I also installed the horizontal support line, which both of them, the resistance and support line, here it considered as descending triangle. I also installed a stochastic indicator with 14 days period. These lines are connecting the point that the price hit the resistance to stochastic indicators. Look here, I connect these two, and also the point that the price hit the support, I connect it to the stochastic indicators. Now here the price is originally going upward and it gets rejected by the resistant area and going downward. So here you have to go short, and if you look at the stochastic indicator, they are in overbought area where you have to go short or exit the market. So both of them, they are in line. Look at here. This is where the price got rejected by the support area and going upward. So you have to enter the market here, and the price is in a stochastic indicator, the price is in oversold area where you have to prepare to enter the market, so, or to go long. So both of them, they are in line. The same thing, this one and this one, they're in line. This and this, they're in line. This is they're in line. So finally, where the price, after bouncing up and down to support and resistance, finally the price break the support, break down the support, and after a little bit pull back and then going sharply downward. Now if this is a good place that you have to exit the market, and you put your stop loss maybe 1 or 2 ATR above this pullback. Now if you go short around resistant area, then you have to put your stop loss 1 or 2 ATR above this trend line. And if you go long around support area, here or here or here, then you have to put your stop loss 1 or 2 ATR below the support area. Remember, a stochastic indicator measures the momentum and trend strength in the market. It cannot make decision for you, but you can use price action knowledge, and it will facilitate your decision-making process where you have to enter or exit the market. Another thing that I want to mention is here that anytime that you see a descending triangle, this rule is very strong and it works. The resistance into support, when the price goes from resistance to support, then the result is it breaks down the support. Result is breaking down. So you have to prepare, you have to watch for this breakdown. So that is the rule. So in descending triangle, resistance into support, result breakdown. Support and resistance using stochastic indicators continue. This is the price trend, FEC stock, and H1 time frame. I installed the horizontal resistance line, and also I installed the trend line, which is acting as a support area. Now the two resistance and support considered as ascending triangle. I also here installed a stochastic indicator with 14 days period, and also I am connecting all the points that the price hit the ascending triangle to a stochastic indicator. And these are the points that you see the price hit the support area in 2-3 places or 4 places. So I connected to stochastic indicators here, and also it hit 1-2 area, or here 3. So I connected to a stochastic indicator. Look whether they are in line or not. For example, this one. the price hit the support area, and after that it got rejected by the support and going upward. Look at that. The price here is touching the 20% line oversold area, so you can enter the market and you ride on this trend. So they're both these 2 points are in line. Look at here, the price in a stochastic indicator, they are in overbought zone, so you can exit the market here. And here, look, the price hit the resistance and bouncing back, so you have to exit the market here. They're both of them, they're in line. Same thing here, they are in line. Same thing here, they are in line. So basically, a stochastic indicator is very, very good in order to use, or in order to help you where you enter or exit the market. Now finally, when the price hit a couple of times support and resistance, and finally it hit the resistance, broke the resistance and broke out the resistance and going upward. So as soon as the price break the resistance and close above the resistance, the next candle open above the closing price of this candle, you can enter the market and you put your stop loss 1 or 2 ATR below the resistance level. And around this area, you have to put your stop loss above resistance, and in this area, you have to put your stop loss below the support. Now, in general, in ascending triangle, support into resistance, support into resistance, support into resistance, result breakout of resistance. So this is a very good point that you remember. The third strategy is Forex day trading using Bollinger Band indicator. Now, Bollinger Band is a technical indicator used to identify the overbought and oversold condition to measure the market's volatility above and below the median. The period of low volatility are followed by the period of high volatility, which means a significant price movement is on the way. A buy signal is generated when a full candle painted above the median while the trend is going upward. A sell signal is generated when a full candle painted below the median while the trend is going downward. Bollinger Band buy signal continue. In downtrend, if the price exits the lower band with a bearish candle and closes outside the lower band and then return back again and closes inside the lower band with a bullish candle, then a buy signal is generated. Bollinger Band sell signal continue. In an uptrend, if the price exits the upper band with a bullish candle and closes above the upper band and then return back again and close inside the upper band with a bearish candle, then a sell signal is generated. Forex day trading strategy using Bollinger Band and MACD indicator. This is the price trend, Euro USD pair 4H time frame. I installed MACD indicator with 12.26.9 parameter, as you see here. And this is the MACD indicator. And also I install tree line, which connect the important point between MACD indicator and Bollinger Band, MACD and Bollinger Band. Now, the trend originally going downward, and from here it goes on consolidation and range, and you see there is not that much fluctuation going on. You see this in MACD indicator. The size of the histogram bar is very small and it shows flatten, and the amount of downtrend is very, very small and negligible. Now, at this point, The blue line, the MACD line, crosses the orange line while going upward. That's a sign of an uptrend. You see the length of a histogram bar is increasing, and here you see the trend is going upward because the Bollinger Band expands in both sides. That's the sign of high volatility. So that is the reason both are in line. Now, if you enter the market at this candle, you can put your stop loss below the lower band, maybe 1 or 2 ATR. And if you enter the market at this candle, then you put your stop loss 1 or 2 ATR below the median. Now, here it generates a buy signal. You see, MACD indicator generate a buy signal, and the same thing, Bollinger Band generate a buy signal too. This candle closes above the median, and that's the sign of a buy signal. Now here, look at here, the green candle exit the upper band and close outside and return again back inside with the bearish candle and close inside. That generates a sell signal. Now again, the MACD indicator, from this place that the green histogram bar changes to red, that from here the trend going downward, but the entry point is here, the sell signal. But where here there is a little bit difference between this point and the exit point here, because the two band act as a leading indicator and MACD indicator act as a lagging indicator. So it lag these 3-4 candles. So you can basically exit the market at this candle. Right, if you come down, you see where the candle changes the color. So that's the sign of a downtrend. So you exit the market at this candle and you put your stop loss 1 or 2 ATR above the upper band. Now here, MACD indicator generate a sell signal at this point, and the trend is going downward, and you see the trend is going downward. Now here, MACD indicator generate a buy signal here again, and you see in Bollinger Band this candle penetrate the median and close above. So you can enter the market here and put your stop loss below the median, maybe 1 or 2 ATR below the median, and ride on this big trend. So you see MACD indicator, Bollinger Band and MACD indicator, they are in line, and you can use both of them to find buy and sell signal to enter and exit the market and make profit from the stock market. Finally, the last strategy is Forex day trading using candlestick pattern. Candlestick pattern in Forex day trading is one of the most widely used among traders. It can help to identify trend reversal, price breakout or break down the market structure, and price continuation pattern when monitoring currency pairs. There are over 40 recognized Forex chart pattern in total that you can spot reversal. You can also use candlestick math blending if you do not remember the name of a particular pattern. Technical analysis is the best tool to determine uptrend and downtrend within the Forex market by drawing support and resistance areas. Traders should always be aware of potential risk following these patterns and protect their asset from being wiped out due to sudden market reversal. Forex day trading using candlestick pattern. This is the price trend. New Zealand USD pair 4H time frame. I installed resistance level and also support level. Now the trend is originally going downward and coming inside the range, bouncing between support and resistance, and finally break down the support and going downward, have a little bit pullback and sharply going down. Here you can, that's a good place to exit the market and put your stop loss maybe 1 or 2 ATR above the pullback. So the trend is going downward, and here at the bottom of the downtrend you see these 3 candles. It looked like morning star, which suggests trend reversal from downtrend to uptrend. But if you doubt, you can blend these 3 candles with candlestick math blending, and the outcome of these 3 candles, I enlarge it right here. So here, these are the same 3 candles. Then you take the open of the first candle, you take the close of the last candle, and you take the high and a low of the pattern. So the outcome is nothing but a bearish hammer, which suggests trend reversal from downtrend to uptrend. Now, if you want to enter the market, here you have to wait for the next candle, which is this one, to form above the outcome of this 3 candle, and then you put your stop loss below the low of the equivalent of these 3 candles. Now the trend is going up. At the top of this uptrend, you see a bearish engulfing these 2. That is the bearish engulfing, suggests the trend reversal from uptrend to downtrend. Now you wait for this little candle to form below this bearish candle, and then you exit the market and you put your stop loss 1 or 2 ATR above the high of these 2 candles. Now the trend is going downward, and at the bottom of a downtrend you see these 4 candles, 1, 2, 3, 4. Now you can blend these 4 candles with candlestick math blending, and so these are the 4 candles, and the outcome of these 4 candles, I enlarge it right here. These are the same 4 candles, 1, 2, 3, 4. You take the open of the first candle, you take the close of the last candle, and then you take the high and a low of the pattern. So the outcome is nothing but this bullish hammer, which suggests trend reversal from downtrend to uptrend. Now in order to enter the market, you have to wait for this candle to form above this, the outcome, or above this big candle. Now, and you put your stop loss 1 or 2 ATR below the low of this 4 candle. So this is how you use candlestick pattern and candlestick math blending in order to find the entry and exit point for Forex day trading and make profit from the stock market. Forex day trading using candlestick pattern. This is the price trend New Zealand USD pair 4H time frame. I got all my chart in this video from Yahoo Finance. I installed resistance and also support level, and also I installed dynamic trend line, which act here as support area. The price is coming into the range, bouncing between support and resistance, and here it got rejected by the support area, and now I blend these 3 candles to see why the price is going upward, and I see the outcome is nothing but a hammer. So that is the reason the price is reversing, going upward. Now, if you want to enter the market at this place, you have to wait for the next candle to open above these 3 candles, and then you put your stop loss, maybe 1 or 2 ATR below support area. So the price going up all the way, and finally it hit the dynamic support area, and due to this bullish engulfing, which suggests price reversal, the price is bouncing upward. So you can enter the market here and put your stop loss maybe 1 or 2 ATR below this support level. Now the price is going up, and at the top of its upward trend we have a shooting star suggesting price reversal. So you can exit the market here. Now the price is coming to support, and it gets rejected by the support due to this hammer. So you can enter the market right here and put your stop loss below the low of the hammer, maybe 1 or 2 ATR. So the price moving upward, and at the top of this uptrend we have a shooting star that is suggesting price reversal. You can exit the market here. The price coming back down to support area, and it gets rejected due to these 2 candles. I blend these 2 candles to see what is the outcome of these 2 candles, and the outcome is nothing but a hammer. It's suggesting price reversal. So the price reverses. You can enter the market here, and you put your stop loss maybe 1 or 2 ATR below the low of these two candles. At the top of this upward trend we have a bearish engulfing suggesting price reversal. The price reverses and hitting the support area, break down the support and heading downward, and finally have a little bit pullback, and at the top of this pullback, because of this shooting star, the price reverses back. So you can exit the market when the next candle after the shooting star closes below the shooting star. Then you exit the market and you put your stop loss maybe 1 or 2 ATR above the high of the shooting star. So the price finally going downward all the way, and at the bottom of this downtrend we have these 3 candles, which the outcome of these 3 candles is nothing but the hammer, which suggests price reversal. So we see that we can use candlestick pattern and candlestick math blending in order to find the proper entry and exit point, and you can use your stop loss at the right places, that you don't lose money. So this is how you can trade Forex day trading and make money from the stock market. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.